In this video, I'm looking at 7 top stocks that you should be looking at for 2020. I've done hours and hours of research, and these are 7 stocks that I have a great deal of confidence in. This is because they either offer a lot of upside and value or strong and continued growth into the future. Make sure to watch this video until the end so you can get my full analysis on each of these 7 companies. So the stocks I'm going to be talking about in this video are a little bit less speculative than my latest high growth video. That means that some of these stocks could see a little bit less growth, but they are also a lot less risky. For any investor, I recommend having a balance of risky and safer stocks. In general, the more diverse your portfolio, the safer. So with that, let's get started on the 7 top stocks that you guys should be watching right now. Number 1 on my list is Gilead Sciences, GILD. This is a biopharmaceutical company that researches and develops drugs. Its current trading price is $81.80 with a 52-week low of $60.89 and a high of $85.97. If we zoom out to the 6-month chart, you can see that it's remained relatively flat since the end of last year and the first month of 2020. After that, it's shot up dramatically. And we can also see that there is quite a bit of volatility in the last month. So recently, you may have heard of Gilead through its experimental drug, remdesivir. This drug is currently awaiting clinical trial results for actually treating COVID-19. We've seen mixed results based on previous studies, but actually recently, we've seen some really good results. Very recently, their US trial comparing a 5-day dosage of remdesivir with a 10-day dosage actually showed that at least 50% of patients on the 5-day dosage improved. Note that this study actually did not have a control group, but the results are still very promising. You can also see some pretty great success stories in the news, and it's really heartwarming to see. Of course, we can't be certain that this drug is actually what caused the recovery, but a lot of people do think that this drug is very effective. Still, I think this is a good buy, even without this coronavirus treatment. In the long run, I still think that Gilead Sciences will have positive growth regardless of its success with a COVID-19 treatment. So first of all, Gilead has a good and solid dividend. Since they started paying out their dividend in 2015, it's actually increased by 50%. Right now, their current dividend yield is 3.24%. Also, if we take a look at their PE ratio, we can see that it's 19.95, and they have a market cap of $105 billion. As far as their liquidity, I like Gilead because they have a very good current ratio. Right now, their current ratio is at 3.10. And this basically means that they have 3 times as much current assets as they have current liabilities, meaning they will not go bankrupt anytime soon. They also have a high gross margin of 79% and a high net margin of 24.13%. Whatever the news with Gilead is, I think it is a good long-term hold. There will certainly be a drop if remdesivir does not work, but in the long run, I do see a good trajectory for this company. So definitely consider buying this if you're looking for a solid healthcare stock. Okay, number 2 on my list is Synchrony Financial, SYF. This is a consumer financial services company. It's actually not too well known, but it is a very large company. In fact, a good amount of you guys may have already used their cards without even knowing. In terms of their services, they do banking as well as credit cards. And for these credit cards, they mainly work with different stores to create these store credit cards. So for example, Amazon, Lowe's, and a ton of other retailers use Synchrony for their own store credit cards. As a result, they have a huge $80 billion loan portfolio. So right now, Synchrony is trading at $19.80. They actually had a huge come up in the later half of April. If we zoom out to the 6-month chart, you can kind of see that they are really hit hard with a 45% drop from all-time highs. This is because during a recession, people just choose not to pay off their credit cards if they can't afford to. Basically, it's the last thing to get paid off. Also, as a result of the high unemployment numbers, there's definitely less spending than there was before. Synchrony's 52-week low was $12.15, and their 52-week high was $38.18, with a market cap of $12.3 billion. Right now, they do have a price to earnings ratio of just 4.45, which is quite low. This definitely means that shares of Synchrony could be undervalued right now. And it also has a very solid 4.45% dividend yield based on its current price. So Synchrony just released their first quarter earnings, and they're doing quite well. It is a very profitable company, and this is mainly due to the super high high interest that their store credit cards have. Just a side note, whenever you apply for a store credit card, be wary of the interest rates that they have. You definitely don't want to be missing any payments on those cards. So right now, Synchrony does have a 15.15% net interest margin, and that makes its 5% charge-off ratio not seem too bad. This 5% charge-off ratio, that's basically how much of their debt is not paid. It's basically their losses. So, even if you're losing that 5% of debt, you still have that 15.15% net interest margin to kind of save you. Another cool thing is that Warren Buffett actually invests in this company, which is always a good thing. He prioritizes companies with good long-term potential and also strong financials. So if you trust Warren Buffett, then this might be a good pick for you. Yes, it is an underdog. It's not quite well known right now, but they are expanding their business. Right before the pandemic hit, their purchase volume on their cards were actually up 10%, meaning that they had a lot of upward momentum. Like I said, they have very high profits, and this is due to the fact that they don't have any cost of goods and they have high interest rates on these cards. Synchrony has a gross profit margin of 88.03%, and after operating expenses and taxes are factored in, their net margin is 24.01%. If default rates are high in the near future as a result of this pandemic, then that could cause some trouble for Synchrony. But as of right now, I do think that their stock is undervalued and there is a lot of upside for future growth. This is also a long-term pick, and we might see some bumps along the road. So yes, a little bit risky, but with a lot of upside potential to grow back to where it was before. Okay, number 3 on my list is AMD, Advanced Micro Devices. This is a semiconductor company that develops computer processors and related technologies. Right now, AMD is trading at $51.45 with a 52-week low of $26.03 and a high of $59.27. They currently have a market cap of $62.8 billion. This stock hit a high in mid-February, dropped down to about $40 per share, and now is back to around $50 per share. The reason why their price actually fell in the last few days was because AMD cut their future growth outlook by providing full guidance for 2020. They are projecting 25% revenue growth for 2020, which is actually lower than the previously forecasted 30%, and that's kind of why it dropped. However, you guys, 25% revenue growth is still very good. It's quite obvious that AMD hasn't been hit quite as hard as a lot of other companies during this pandemic. If we compare AMD to Intel, you'll see that AMD focuses more on the gaming side, whereas Intel is more on the commercial side. So of course, with the pandemic, gaming is up, and that is why analysts think that AMD should have positive upside this year. So recently, AMD reported revenues of $1.79 billion, and they are expecting revenues of $1.85 billion in quarter 2. If we compare this to last year, their revenue was just $1.27 billion in the same quarter. So obviously, that is a lot of growth. They also reported a 73% increase in their computing and graphics chip sales, all the way to $1.44 billion. And guys, since the new PlayStation 5 is coming out, as well as the Xbox Series X, we should expect sales to heavily increase in the second half of 2020. So one bad thing about the stock is the PE ratio, the price to earnings ratio. Right now, the PE ratio is 124, which is extremely high. This is my biggest concern about the stock. But if you're an investor that doesn't really care too much about the PE ratio, then this wouldn't matter as much to you. This high ratio just means that they are earning very little compared to their stock price. And that could be a sign that the stock is overvalued. In terms of their liquid cash, they are doing just fine with a current ratio of 1.95. This means they have almost twice as many current assets as they have current liabilities. Though they have a good gross profit margin of 42.62%, their net margin is much lower at 5.07%. So right now, I do think that AMD is on the uptrend, even with the small drop recently. I think that with this stock, you probably won't see as much upside in the short term, especially if you compare it to some of those riskier stocks. But if there is another drop in the near future, definitely consider hopping on the stock. For me, this is one of the safer stocks, but its only downside is that its PE ratio is just so high right now. If AMD can get their earnings up a lot, then I do think that this would really support its growth in the future. However, AMD is a solid, good company with very good financials, and I am quite positive that we will see good long-term growth. Okay, next up on my list is Store Capital, STOR. This is a real estate investment trust REIT, that focuses on owning freestanding buildings that are leased out to retail stores. Obviously, with the shelter in place going on and lots of stores closed, you can see why its price has dropped dramatically. Store Capital is currently trading at $19.65 with a 52-week low of $13 and a 52-week high of $40.96. Their current market cap is $4.9 billion. So if we zoom out to the 6-month chart, you can see that there was a huge drop starting in mid-February. It pretty much went from its all-time high all the way down over 50%. Yes, this pandemic has caused a huge hit to commercial leasing. However, let's talk about their current portfolio of over 2,500 buildings. It is actually quite well diversified, with almost 500 different clients in 100 different industries. However, like I kind of mentioned before, that can't save it from the current shelter-in-place laws, as well as most physical stores being closed right now. There is a reason why a lot of other YouTubers recommend the stock. And there's also a reason why Warren Buffett invests in the stock, and it's actually his only REIT in his portfolio. Interestingly enough, he actually owns about 8% of this company. But yeah, if you think that the economy will recover in not too long and people are going to be returning back to these stores, then right now I do think that this is a good stock to buy. Store Capital says that as of right now, 64% of their tenants had paid their April rent. Most of those that did not pay are actually on some type of deferment plan, which means that they will receive the rent in the future. So yeah, buying the stock right now in the short term, it is risky because it's really based on this virus and how this whole thing plays out. If there is a resurgence in cases and we see a second or third wave, then this would be really bad for the stock. However, if you are optimistic, then this might be a good pick for you. So their current PE ratio is 16.29, and it's actually a pretty great dividend stock right now with a dividend yield of 6.98%. Yes, this is a bit inflated right now due to the huge price decrease. So if you take a deeper look at the dividend, yes, it could be stopped or it could be reduced in the future. It really depends on the earnings and if these stores are able to pay their rents. However, if we look at the history of its dividend, it's actually been increasing ever since the dividend program was started. Now, when all rents are being received, Store has a very high profitability. Its gross margin is 64.98% with a net margin of 42.61% after operating expenses and taxes. This of course is very good, but right now their margins are not like this just due to the fact that not all their tenants are able to pay rent and they probably have more lease vacancies. So yeah guys, this is a risky stock to hold right now because it really depends on the virus and how the tenants are holding up. If these stores are going bankrupt or they're having to close, then that's really bad for Store Capital. But if you think that the economy will get better in the near future and things will mostly return back to normal, then this could be a good buy. I personally think that commercial leasing will take a big hit in the short term, but in the long term, I think they should just be fine. But that is also because I have a very optimistic view of this whole COVID-19 situation. Next up on my list is Delta, DAL. And this company doesn't need an introduction. They are one of the biggest airline companies in the world. Yes, I have mentioned Delta in my previous videos, and I want to mention them again just because I really do believe in them. So right now, Delta is trading at $25.47, and they have a 52-week low of $19.10 and a high of $63.44. Based on their current valuation, they have a pretty low PE of 4.81, and right now they are not paying a dividend just based on the fact that their earnings are completely shot. If we zoom out 6 months, we can see that they saw a huge decline of about 60% due to the pandemic and reduced air travel. I think that with the reopening of states, people are getting more optimistic, and travel and going out, it's going to return back to normal in not too long. Yes, we know that airlines are getting hit hard, and this shows in their earnings for the first quarter. Delta's revenue fell 18% to $1.9 billion, and this resulted in a $534 million loss. This was their first quarterly loss in 5 years. A big chunk of this pretty much came from the fact that most of their international flights were stopped. With the world looking like it will recover at some point, this will bring in this much needed revenue. Also, it's about time for them to get their domestic flights back because these have seen a huge decrease as well. However, note that Delta does expect their Q2 earnings to be lower than their Q1 earnings. So in the short term, buying the stock is still risky. We really don't know what's going to happen with Q2 and what will happen to the price when those earnings reports are released. I did mention before that Delta has cash flow issues, but that does seem to be less dangerous than it was before. Delta did receive $5.4 billion in funding through the CARES Act. And with that deal, they did agree to let the government purchase 1% of their stock over 5 years at $24.39 a share. It's also getting more funding from investors, and they're not going to be spending any money on aircraft in 2020. They currently have 184 planes on order from Airbus, but they are deferring the payments and delivery to a later date. Guys, I must stress that this is not a short-term gain stock, just due to the fact that Q2 revenues will probably be worse than Q1 revenues. But from Q3 and onward, it seems like Delta could make a solid comeback. And I do believe that within a few years, you will see a great return on investment if you do invest in Delta. It's still risky and speculative based on the cash flow issues, but definitely consider investing in the stock if you are a long-term believer in air travel. Okay, number 6 on my list is Shopify, S-H-O-P. This is an e-commerce platform that actually hosts over 1 million stores currently. Pretty much every dropshipper, every small brand, and even a lot of large brands will use Shopify as their e-commerce platform. And that's because Shopify is the king of all things e-commerce. Personally, I believe that they are the future of e-commerce and also commerce in general. With this pandemic, we've seen a ton of physical stores closing. Many of these are not yet online. They are small mom and pop shops that haven't set up an online store. This pandemic has sort of opened up the opportunities for all these store owners to actually create an online store. They may realize that they might not need a physical storefront and that they can actually generate revenue online as well. So currently Shopify is trading at $618 with a 52-week low of $242.23 and a high of $665.74. They currently have a market cap of $74.5 billion. If we zoom out on its chart, we can see that it did drop quite a bit in March, and since then it's made a meteoric rise back to the 600s. So since its IPO, Shopify has generated massive gains. Back in May of 2015, it came out starting just at $17 a share. A lot of these gains are attributed to the high growth of e-commerce in general. I do believe that a ton of these small stores will start to set up online shops after this pandemic. They're going to realize the importance of multiple streams of income, and who knows, there might be a second wave of infections, and with that, we'll see even more people starting to open up these online stores. Okay, so you might be thinking, like, it's seen a huge growth in its value, so could that mean that it's already overvalued right now? This could be true, but I personally am looking at the long term for the stock. I think that Shopify is one of the next Amazons, but it just sucks that its share price is so high, which prevents a lot of people from investing in this company. So a quick look at their numbers. Shopify sales are up to $1.58 billion in 2019, which is significantly higher than their sales of $205 million in 2015. Shopify has a subscription model as well as a ton of add-ons for websites. And they also generate quite a bit of revenue from their payment processing fees. Analysts do expect their revenues to grow by as much as 38% in 2021. Overall, I really like Shopify, and I'm a huge believer in their long-term growth. Right now, their valuation does seem a bit high, which does worry me a little bit, but I am confident that this company will grow its numbers in the next 5 to 10 years. This is not a short-term buy, as I think their super high price to earnings ratio is unsustainable until their earnings kind of catch up. However, they do have a good competitive advantage over other new platforms that could emerge. I know this is sort of a rare pick, and one reason is because it is quite expensive and not a lot of people can buy into it. But I did want to include it in this list because I know that Shopify will be the biggest player in the rapidly expanding e-commerce space. I've been in e-com for the last 4 years, and trust me when I say that everyone uses Shopify. There really is no other alternative. And when the rest of the world realizes that they need to sell products online, Shopify will be the platform that most of them use. So I will be adding more of the stock if I do see a dip, but I also wouldn't mind buying it at its current price if that is specifically what I wanted to invest in. Okay, last on my list, number 7 is Microsoft. MSFT. Currently, Microsoft is trading at $176.25. Their 52-week low is $119.01, and their 52-week high is $190.70. This is a huge company with a market cap of $1.35 trillion. If we zoom out on its graph, we can see that it's dropped a significant amount starting in mid-February over the course of a month. And then after that, it's pretty much gone right back to where it was. Microsoft's current price to earnings ratio is 29.84, and they do have a current dividend yield of 1.14%. So overall, I am a huge believer of Microsoft in the long term. In the last 12 months, they have generated $40 billion of clean cash flow, and their balance sheet is extremely solid. So yeah, if we take a look at their balance sheet, you can see that they have $134 billion in cash and other short-term investments, with total current assets at $175 billion. Now, if you add all their property and intangible assets, then their total assets is at $286 billion. This number has been going up for the last 5 years, which is always a good sign. Their total liabilities right now comes in at $184 billion, which is not bad when compared to its assets. So a balance sheet like that doesn't go unnoticed, and that gives them a huge advantage during a downturn like this. Its major revenues in the last few months come from server and cloud services. Earlier in April, Microsoft saw a huge spike in the use of their Microsoft Teams collaboration software. In addition, the Microsoft Azure cloud platform sees a lot of potential, and they also saw an increase of 52% in their cloud revenue. Yes, the recent rally has some concern, and we might see some bumps in the next couple of quarters. But in the long term, I think Microsoft is a great buy, as they are not going anywhere. And I do believe that we will continue seeing their earnings grow and grow. This is a recession-proof company that will leave the tech, productivity, and gaming spaces for years to come. Maybe you don't need to necessarily buy right now, as we might see some dips in the future. But the long-term growth of this company, Microsoft, is almost guaranteed. And that's why I recommend you guys take a look at this company and potentially invest in it. Like always, you guys, make sure to do your own due diligence before actually buying a stock. It's really important that you research for yourself what the company is and see if you personally think that it is something good to invest in. I'm just some guy on the internet, but I just want to make this video to show you 7 stocks that I think are worth looking at and could be good buys. But in the end, it really is up to you. These are just my opinions. If you haven't already, make sure to sign up for WeBull and claim your 2 free stocks worth up to $1,400. All you have to do is sign up for an account using the link in the description below, deposit $100, and you will get your 2 free stocks. I personally use this platform, and it is very simple to use, and it's completely free as well. Okay guys, that's it for this video. Make sure to share this video with a friend if you do think that they could benefit from the information that I did present. These are 7 top stocks that I see a lot of potential in, so I hope you guys got some good value out of this video. If you did, make sure to hit that like button and also subscribe to see more videos just like this. I make tons of videos about investing, personal finance, as well as entrepreneurship. Okay, thanks so much you guys. I will see you in the next video. Peace.